In this chapter, we will talk about stockholders' equity. So far throughout the semester, we have covered assets. We talked about merchandising companies, and we talked about their inventory. We talked about current assets, cash. We talked about property, plant, and equipment. And we talked also about liabilities. With assets, we also talked about receivables. We later on talked about liabilities, long-term liabilities, as well as current liabilities. And now in this chapter, we will talk about stockholders' equity, the main sources of stockholders' equity. We will talk about stocks and dividends and retained earnings. Now, before we start learning how to account for stock transactions, we need to understand corporations, and we need to see the difference between a corporation and a partnership, for example. We already touched on this topic in the early chapters of the semester. However, here we'll talk a little bit into more detail. Basically, any company, any entity must be kept separate from its owners as well as from any other entity. Basically, if you remember the economic entity assumption, an economic entity must be like the records for a certain company must be kept from the records of the owners as well as the records of any other entity. Companies or corporations could be classified according to various factors such as the industry, size, etc. However, the main methods of classification for corporations is by purpose and ownership. Companies could be classified based on their objectives. For instance, for-profit versus not-for-profit. For-profit corporations are similar to, for example, Best Buy, Procter & Gamble, Target, Walmart, etc. Those are companies whose main objective is to make money and to make profits. The other type would be not-for-profit. Those are, for example, the Red Cross, Salvation Army, and other charities, where the main objective is not to make money, but to provide certain services. The other type of classification depends on the type of ownership and whether the company is privately held or publicly held. Now, until recently, for example, Facebook was privately held company, and when they basically issued their IPO and they sold their stock in the stock market, they became publicly held company. And for example, Deloitte is a privately held company, and here the main difference is that publicly held companies can be have their stocks in the stock market and can be traded on the stock exchanges, whereas privately held companies cannot be traded on the stock market. There are several characteristics of organizations, and we have talked about many of these, and those they distinguish a corporation from partnerships and proprietorships. The main importance is that they have certain advantages and disadvantages. So basically, the company, a corporation, is a separate legal entity. It's a separate legal exit. It has its own name. It can buy assets. It can own as a building, for example, under its own name and not under the name of the shareholders or the owners, basically, of the company. It has the right to rent, to lease, to do business separately from its shareholders. It also another main basically difference between partnerships and proprietorships is the limited liability of the owners. With partnerships and proprietorships, as we remember, they are liable if the business goes bankrupt, the creditors will have claim against the personal assets of the owners of that business. Whereas with corporations, the liability of the shareholders is limited to their investment in that company. Basically, what they will lose is their investment in the company, which was in the form of paid of capital. So the corporations also enjoy transferable ownership rights, and by this we mean that stockholders, they have the right to sell their stocks without getting the approval of all the other partners, unlike ownerships or unlike partnerships. For example, with partnerships, the consent of all the partners is required in order to sell your part of the company. Whereas with corporations, the owner of the shareholder, basically a shareholder, can sell their stocks without consulting the other owners. Now, corporations also have the ability to raise capital in a much easier way. They can issue stocks, or basically they can issue stocks to raise capital. And unlike with partnership, where one of the partners would have to actually bring in the money, otherwise they would have to partner with another person, and it would be a much more complicated issue. Whereas with corporations, they simply, if they needed some cash, they can issue stocks and raise capital. Another advantage of corporations is the continuous life, and this is basically related in a way. This is in a way related to the transferable ownership rights, because the company basically will not be dissolved with the withdrawal or death of one of the partners. The ownership of the stock will simply move on to the next owner, basically to those who inherited the dead, basically the one of the shareholders in case of death, or in case of selling, etc. It becomes the ownership of the new shareholder. As a result, there is no need to dissolve the company, and this is why we say that it has an indefinite life or a continuous life, because it does not depend on the life of the owners, which is the case of partnerships, where the company gets basically the partnership gets dissolved in the case of death of one of the partners. However, corporations also have some disadvantages. For example, they have to follow additional government regulations. For example, state law defines the requirements for issuing stocks and the effect of retiring stocks, paying shareholders back some earnings, etc. Federal regulations, they would govern the trade of stocks. For example, sale to the general public. The SEC requires also companies to disclose financial information, whether quarterly or annually, and they even decide on the type of or the format of reports, and the standards of financial reports that the companies have to report, etc. Another disadvantage is the fact that because the companies are a separate legal existence, they have to pay or corporations, they would have to pay income tax as if it were basically because it is a separate entity. So basically, the corporation will be paying net income will be paying income tax before any dividend or anything like that is paid to shareholders. And then later on, when shareholders receive their dividends, etc., they will also have to pay tax on their own personal income. In this case, the amount that this money or this profit or this net income will be taxed twice. This is why we call it double taxation. For example, think about it this way. Let's say that this is the net income of the corporation, and this part was paid as tax. So let's put this one here. This one is tax, income tax that the company will be paying. Now the remaining part, let's say that it was distributed to shareholders in the form of dividend, and at this point each shareholder will also have to pay. This is considered as net income for shareholders, and as a result they will also have to pay income tax on their personal income, and this one again it will be paid. This is why it was taxed once and twice. This is what we mean by double taxation. And finally, we also get to the complication of the corporate management of compared to, for example, ownership. Basically, here there is a separate with partnerships and proprietorships. Basically, the owner or the owners of the company, they will either manage the company directly, or they manage the business directly, or they would monitor it closely. They would be involved in day-to-day business operations, etc. And they remain active. They have an active role in managing the company. On the other hand, with corporations, shareholders, they don't directly get involved in day-to-day operations. There is a separation between ownership, which is for shareholders, and company management, which sometimes might create a problem if the management, for example, the CEO, had their own benefits in mind rather than the company's benefits. At this point, for example, they might choose to an action or that might not be optimal to the company, but would maximize their profits, their own profit, the profit of the CEOs, etc. Basically, their compensation, but not the company's profits. So this chart here explains how the organization of the company. Basically, we have the shareholders who elect. So we have the shareholders who elect the chairman and the board of directors, and who in turn basically they develop the policies of the companies, etc. And they would hire the company management, basically the CEO and some vice presidents, such as the CFO, etc. And those that will be this team that is this team who will be managing the day-to-day operations under the supervision of the board of directors. And after SOX, Sarbanes-Oxley required companies to the board of directors to basically increase their monitoring basically of the company's management, and to make sure that everything is basically that the company's company management is doing everything for the benefit, everything that they can do for the benefit of the company, and not only for their personal compensation or personal benefits. fact, some people say that if boards of directors monitored Enron, the management of Enron and WorldCom, etc., if there was a tighter oversight from the board of directors, those accounting scandals could have been avoided. Now, the chief accounting officer of the company is the controller. Their main role is to maintain accounting records and to make sure that the internal control systems are working efficiently and adequately. Also to prepare financial statements, tax returns, internal reports, etc. The treasurer is basically the custodian of the company's funds, and they are responsible for the company's cash position, cash position. So how is a company formed? Companies, they are formed by grant when the state grants them a state charter. The charter or article of incorporation, it's a document that describes the name and purpose of the corporation, types and number of shares authorized to issue, the name of people who form the corporation, the number of shares these people bought, etc. And this document is also basically it is from the state that where the company is incorporated. Companies, in most of the time, they pick a state where the laws, mostly tax laws, they suit their basically corporate form of business most. For example, it doesn't have to be where their main business is conducted. The companies can be incorporated in any state, but just in one state. They can have an existence. They can exist in basically any state. However, they will need a license in every state where the company operates. The companies will be incorporated in one state, and then they will have licenses in the states where they operate. So, like we said, the companies are formed by grant of state charter, and then the company will develop their own internal bylaws. Those are the internal rules and regulations for conducting operations, and basically the company's rules, the company's policies, etc. Companies, they expense organization costs, such as the fees to the legal firms or like the attorneys who help the company incorporate, etc. So companies, they expense these costs as they are incurred. So the ownership, when an investor purchases some stocks, they would also get certain rights. Ownership rights of shareholders, they would include the right to vote. They vote when they elect a board of directors and certain actions where that would require their votes, such as takeovers, etc. This is for transactions that require shareholders' approval. Shareholders also have the right to part of the company's earnings, which is in the form of dividends, and that depends on the number of shares that they have. Another right is called also preemptive right, although a lot of companies are eliminating this right. However, preemptive right allows the owners, the stockholders, basically to keep the same percentage of ownership when the company issues new stocks. So when the company issues new stocks, basically the owners of the stock, basically the shareholders, before issuing new stocks, will have priority to buying the number of stocks to keep the same percentage of their ownership, the same share of the company once those new shares were issued. It does not mean that they will get those shares for free. They simply have the right to buy them before other people in order to keep the same percentage of ownership in that company. Shareholders also, they have the right to the assets. They have the right to the assets of the company if the company goes bankrupt or if it is liquidated. They have after the company has paid all the lenders, all the creditors, whatever remains will be distributed to shareholders depending on their share of in the company. And this is why it is called residual claim, because first the company will first pay first the company will pay lenders and creditors, and then whatever remains, the residual claim, will be paid to stockholders. So when the company issues stocks, there are several questions that need to be addressed. For example, the number of stocks that will be issued, the price of the stock, the class of the stock, etc. And this here, for example, this figure here shows the basically it's a stock certificate. This is not the state charter. This is a stock certificate that would include information such as the class of the stock. This is a common stock class A. It has also the numbers. It is pre-numbered. It includes information such as the name of the corporation. It includes information such as the shareholder's name. This is important for the company in order to keep track of who has the right to get dividends, etc. later on. This also includes the number of shares that the shareholders has purchased, the par value, the signature of the company, etc. So we have also here the par value that is included, the information here, the date, etc. Of course, the signature of the corporate officials. Now, when like we mentioned before, the state charter authorizes the company. Basically, it includes information on the authorized number of stocks. So it is this charter indicates indicates the maximum number of stocks that the company is authorized to issue. This does not mean that the company will actually issue all these authorized stocks. In fact, most of the time, the companies, they issue part of this authorized stock because the charter would take into consideration current as well as future needs of the company. So this is why they usually, basically, the company would issue part of the stocks, and as a result, the number of authorized stocks is most of the time exceeds the number that is originally sold. If the company in the future requires additional capital, it can raise capital by selling those authorized stocks that they did not issue yet. And the number of authorized shares is often reported in the stockholders' equity section, as well as the number of issues and the number of stocks that are issued and the number of stocks that are outstanding. Now, authorized stock, it means that this is the maximum number of stocks that the charter, that according to the charter, the company is authorized to issue. Issued stock, this is the number of stocks that the company has actually sold, and outstanding stocks are outstanding shares those are the ones that are sold and they are still owned by investors, and we'll talk about that a little bit later on. So when the company issues stocks, they either sell the stock directly to investors, or they sell it through an investment bank. Direct issuance is very common for closely held companies, while indirect issuance is common for publicly held companies. Now, a company, for example, when Google went public, when they issued their first IPO, they actually sold it through an investment banking. And companies, they like several well, they have certain certain advantages of selling indirectly through an investment bank. Basically, they don't risk not being able to sell all their stocks. If they sell all their stocks to the investment banking, basically they have sold all these issued stocks in return for an underwriting fee. So when the company sells their stocks directly to investors, they won't be paying any fees. However, they will risk not being able to sell all their stocks. On the other hand, when they sell it indirectly through an investment banking firm, they will the company will not suffer any risk of not selling all these stocks. And at the same time, the investment banking will be getting a certain fee. And usually, those investment banks, they have people who are expert in selling this kind of basically of selling this kind of products, shares, etc. As a result, they have a lower risk of not being able to sell those stocks. Now, there are several factors, like we mentioned before, that affect the price of a new issue, the price of a stock when it is to be issued, and that depends on, for example, the company's future earnings, or the expected company's future earnings, the amount of dividend per share that the company is expecting, the current position of the company, the current economy, whether there is an inflation or whether there is a recession, etc., as well as the current state of securities market. So as we can see, there are several factors that affect setting the price for a new stock. Now, the market value of the stock depends on some other factors as well. It is mostly affected by the demand and supply, and this is shown usually in the fluctuations when when publicly held companies stocks are traded in the exchange markets. And for example, the price, mostly the price is affected by the financial performance of the company, and basically such as and some indicators such as the company's earnings and the earnings per share and the company's dividends. And in addition to some factors that are beyond the company's control, such as a recession or something like that, those can also cause day-to-day fluctuations in the stock price. In the past, companies used to the charter would indicate the par value of the stock of a certain company, which is basically the legal capital per share that the company is required to keep in order to keep in the business, basically, and not to withdraw, in order to protect creditors and lenders. However, today many states they stopped requiring this because it does not make any sense anymore in certain cases, because the par value is most of the time negligible compared to the market price of the stock. So, for example, Lowe's Corporation has a par value of 1 cent when the stock is actually traded for over $35, which is to mean that this par value is negligible compared to the stock price itself. And in certain cases, when the company is does not have a par value, such as, for example, Procter & Gamble, Nike, etc., which is very common nowadays, this board of directors, sometimes they might assign a stated value to no par stocks. So the par value is indicated in the state charter. The stated value is assigned by the board of directors. Like we mentioned before, stockholders' equity can come from one of two, can be obtained from one of two sources. Basically, we have either paid-in capital or retained earnings. So paid-in capital basically is the amount of this is the money that this is the contribution of the investors. This is the money that investors paid in order in return for basically for common stocks or preferred stocks. On the other hand, retained earnings is the part of the company's net income that the company management decides to keep in the business for future use or future expansion. This comes from the company's operations. So retained earnings, they come from company's operations. This is the part of the net income that the company keeps in the business, whereas paid-in capital is the money that that investors and shareholders pay in return for capital stock. Now, stockholders' equity, which is also known as shareholders' equity, owner's equity, residual equity, etc. This would usually, like we said, it is divided into two. The main sources of this equity is the paid-in capital and retained earnings. Paid-in capital could be either common stock or preferred stock, whereas retained earnings helps indicate the continuation and growth of a certain company. And it is very important to know how to know and to distinguish between those two sources of equity, because companies legally are not allowed to pay dividends from paid-in capital. They can only use retained earnings to pay dividends. They don't have the right to use paid-in capital to pay dividends. So with comparison to owner's equity, this is basically to proprietorship. Usually the proprietorships, they only have one. This would be the capital of, this would be the capital that was contributed by the proprietorship or the partners. That would be one. Basically, if there were a partnership, it would be one capital account per partner. On the other hand, corporations, they have the two sources of equity. They have stock, basically paid-in capital, and retained earnings. And if the company had also preferred stock, they would also have preferred stock. So let's see here. Let's start recording those transactions. At the end of its first year of operation, Doral Corporation has 750,000 of common stock and net income of 122,000. First, we need to prepare the closing entry for the net income, and second, we need to prepare the journal entry for basically we need to prepare the stockholders' equity section in the balance sheet. So from previous chapters, if you remember, we had the closing entries. We used to close revenues and expenses to income summary, and then we would close income summary to retained earnings and dividends to retained earnings. And the way to and because we have here a net income, the closing entry would include a debit to income summary and credit to retained earnings. This is the closing entry to close net income. This is basically to close the net income to retained earnings. And for the stockholders' equity, like we mentioned before, we need on the balance sheet, we put stockholders' equity. Under that, we have two sections: paid in capital, which includes in this case common stock, because this is the only type of stock that the company has. It's for the value of $750,000. And then we have retained earnings, which is for the value of which from the closing here, it is $122,000. So the stockholders' equity, the total stockholders' equity will be the sum of the two, which is $872,000. As we mentioned before, the main objectives of accounting for common stock issuing is to keep track of the sources of equity, and distinguish between retained earnings and paid in capital. And when a company issues common stocks, only paid in capital accounts are affected, because retained earnings are affected by revenues and expenses as well as dividend, but they are not affected by common stock. So companies, when they can issue stocks at par value or above par value, it is very, very uncommon to issue stocks below par value, because in many states it is illegal. And if this is to happen, if a company issues common stocks at lower than par value, the company will debit paid in capital in excess of par value, and if the balance is not enough, at that point it will debit retained earnings. But like I mentioned, this is very, very uncommon, because it is, in many cases, it is illegal. So let's go back here to our example. Here, assume that Hydroslide Inc. issues 2,000 shares of $1 par value. So, of par value common stock. Prepare Hydroslide's journal entry if 1,000 shares are issued for $1 per share. This is the company here. The company is issuing par value stocks at par value, and it could all. And this is A. B. 1,000 shares are issued for $5 per share. So those are the same stocks. 1,000 were sold. So when we say that the company issued stocks, it means they sold stocks. So when the company issues 1,000 shares for $1, the company will be receiving cash for the value of 1,000 multiplied by $1. So the company will debit cash 1,000, credit common stock 1,000. This is based on the selling price, whereas this one, common stock, is always based on par value. So for B, the company will be receiving 1,000 multiplied by 5. That will be $5,000. Again, this is based on the selling price, which is 1,000 shares multiplied by $5. So the company will debit cash 5,000. The company will credit common stock, once again, 1,000. This is always, common stock is always, will be recorded at par value. When the company issues par value common stock will be recorded, will be credited par value, and the difference between the two will be credited to paid in capital in excess of par value. So this is the difference between the two. So this account here is a stockholders' equity account. It will be listed under the paid-in capital part of the stockholders' equity section on the balance sheet. So this is a partial balance sheet. Stockholders' equity is divided into two parts. We have paid-in capital and retained earnings. Under paid-in capital, we have common stock. We have paid-in capital in excess of par value from common stock, and that would give us total paid-in capital is 6,000. Retained earnings is 27,000, and that would give us the total stockholders' equity. Now, if the company issues no par common stock, this is a common stock that does not have a par value. So in this case, let's say that instead of $1 par value stock, Hydroslide Inc. has $5 stated value. As you remember, the difference between a stated value is assigned by the board of directors. So here the company is selling 5,000 shares at $8 per share. So the selling price is $8. The stated value is $5. The number of shares is 5,000, and we have no par value. So when the company issues 5,000 shares, company will be getting cash for the amount of 5,000 multiplied by 8. That would be 40,000. And again, this is equal to 5,000 multiplied by $8, which is according to the selling price. The company will be crediting common stock stated value. Basically, this is 5,000 multiplied by 5, which is at stated value. With par value, it was at par value. Here, it's at stated value. And the difference between the two is paid-in capital in excess of stated value. So stated value and par value from an accounting perspective are very similar. The terminology will change. Now, what happens if the company issues stocks with no par value and the stock does not have a stated value? In this case, the company will debit cash the 40,000. This is, again, it was based on the stock price of $8. And the company in this case will credit common stock the 40,000 because it does not have a stated value and it does not have a par value. Now, in certain cases, companies, so far we have been accounting for issuing common stocks for cash. This is when the company is actually selling the common stock. But in certain cases, the company might also issue stocks for services provided or to purchase non-cash assets. For example, to purchase a land or a building or something like that. The companies, for example, can issue stocks to pay the attorneys who help the company incorporate. In this case, the cost that will be recorded, for example, for land, the cost that will be recorded is the cash equivalent price. And by that we mean it's either the fair market value of the stock or the fair market value of the asset or of the services provided. So let's see how, and basically whichever is easier to determine. Let's see how this works. So attorneys have helped Jordan Company incorporate. They have billed the company $5,000 for their services. They agreed to accept 4,000 shares of $1 par value common stock in payment of their bill. At the time of the exchange, there is no established market price for the stock. Prepare the journal entry for this transaction. So the first thing is we need to know is which one can be determined in an easy way. Here we have two amounts. We have 5,000. This is the bill. So we have a bill for 5,000, and we have common stock that were for the value of $4,000. Which one are we going to record as organizational expense? At this point, the stock is not is not traded. So at the time, there is no established market price. So which is to mean the stock is not being traded actively. And as a result, we don't know the fair market value of the stock. We know the par value of the stock. So in this case, the bill will be used, the bill amount will be used, and the company will debit organizational expense 5,000 and credit common stock 4,000. Remember, this is always at par value or stated value whenever there is one of them. And the difference between the two will be paid in capital in excess of par value. Let's take another. So in this case, the company was billed 5,000, and then the attorneys, they accepted 4,000 shares of $1 par value, but that stock was not traded. So in this example here, Athletic Research Inc. is an existing publicly held corporation. It's $5 par value, so it does have a par value. It's $5 par value is actively traded at $8 per share, which is to mean this is the fair market value, which can be readily evaluated. So the company issues 10,000 shares of stock to acquire land recently advertised for sale at 90,000. The company is buying a land by issuing stocks. We have two values. We have the advertised amount of 90,000 and we have 10,000 shares. So we have 10,000 shares multiplied by $8. Remember that here the stock is actively traded. So this would be 80,000 or 90,000, which was billed, which was advertised for the price where the land was advertised at this price. Which one are we going to use? In this case, it is easier to determine. Remember that the advertised the advertised price of the land, it is not an exact number compared to, for example, the value of the stock. The value of the stock is 80,000. As a result, we will use the 80,000. In this case, the company will record land at cost, which is 80,000. So it will debit land 80,000, will credit common stock at par value 50,000, and the difference between the two will be paid in capital in excess of par. The par value is never a factor in determining the cost of the land. So as you can see, this one was according to the market price of stock and not on the par value. The common stock is always at par value. Here, basically as a rule of thumb, when the stock is actively traded, it is easier to determine than the actual value, and in that case, whenever the stock is actively traded, most of the time we would use that value. On May 10th, Romano Corporation issues 2,930 shares of $14 par value common stock for cash at $17 per share. So the par value is $14. The stock price, the market price is $17. We need to make the journal entry. In this case, is this answer correct or no? Cash will be debited for 49,810. This is basically 2,930 multiplied by $17. However, will common stock be also debited the same? As we remember, common stock is always debited. The common stock will always be credited the number of stocks issued multiplied by the par value. So actually, this is the correct answer. This is 2,930 multiplied by $14. and the difference between the two will be credited to paid-in capital in excess of par. So as you remember, whenever the company issues stocks, the company will debit cash, according to the selling price, will credit common stock according to the par value, and the difference between the two will be paid-in capital in excess of par. If Vickers Company issues 4,000 shares of $5 par value for 140,000. Now, whenever we have a question like that, first we need to write the journal entry. The number of shares is 4,000 shares. Par value is $5. As a result, and the selling price is 140. So the company will be debiting cash the selling price, 140,000. The company will credit common stock the par value, which is 20,000. This is basically 4,000 shares multiplied by the par value. And the difference between the two will be paid in capital in excess of par. It would be 120,000. So let's see which one is the correct answer. The correct answer will be B. Paid in capital in excess of par value will be credited for 120,000. S lawyer performed legal services for E Corp due to a cash shortage. And due to a cash shortage, an agreement was reached whereby E Corp would pay S lawyer a legal fee of approximately, here the word is approximately, $10,000 by issuing 5,000 shares of its common stock. Par value is $1. The stock trades on a daily basis, and the market price of the stock on the day the debt was settled is 1.8 per share. What's the journal entry that the company will make? Now we have two values. We have 10,000 and we have 5,000 multiplied by the stock price in the market price, and not par value, which is 1.80. So is it going to be 10,000 or 1.80, which is equal to 9,000? Because it is actively traded, we will take the 9,000. As a result, the company is issuing stocks not for cash but for legal expenses. So the company will debit legal expense 9,000. Again, this is 5,000 multiplied by 1.80. It will credit common stock at par value, which is 5,000 multiplied by 1, and the difference will be credited to paid in capital in excess of par. Now, we talked about common stock, we talked about basically paid in capital and retained earnings. However, there is also another account that companies that we need to take into consideration, and those are treasury stock. So treasury stocks is the portion of shares that the company keep in their treasury. Basically, those are the shares that the company has issued, but they bought back, and they may keep it for future if they need some cash in the future, or maybe to basically protect themselves from a hostile takeover. So those are the company's own stock. Those are not an investment in another company's stocks. So the company has issued a certain amount of stocks, and then they might buy them back but not retire them. So they might keep them in their own in their basically vault. They will not be those stocks. They don't have the right to vote. They don't have the right to dividend. And there are, like we said, there are several reasons why companies might do that. Companies might do that to increase earnings per share. They might do that to improve the stock's market value. They might do that to avoid hostile takeovers. They might take them back to also if they wanted basically to reissue them or to sell them to basically reissue them later on to company's management or company's officers as compensation, bonuses, etc. So there are several reasons why a company might buy back their own stock, and at that point it would be treasury stock. When the company buys the treasury stock, they are recorded at the price that the company paid, not at par value. The company will debit treasury stock the price that the company paid. This is a contra stockholders equity account. Stockholders equity accounts, they usually have credit normal balance, a credit normal balance. This treasury stock has a normal debit balance. So those are the contra stockholders equity account. This is not an asset. It is very important to remember that this is not an asset. And when the company buys treasury stock, it will decrease the ownership, the stockholders equity. Why? Because now there are less stocks owned by shareholders that are out there. On January 1st, so let's see how this works out. On January 1st, 2014, Mead Inc.'s stockholders' equity on the balance sheet shows 100,000 shares of $5 par value, common stock outstanding, issued at par value, and retained earnings of 200,000. Here we have shareholders is 100,000 shares at $5 par value issued and outstanding. In this case, the value of the common stock part is 500,000, retained earnings is 200,000. If we look at this one, we see that the 100,000 shares are issued and outstanding, which is to mean that this is that the treasury stocks equal to 0, because treasury stocks are equal to issued minus outstanding stocks. So on February 1st, 2014, Mead acquires 4,000 shares of its stock at $8 per share. How does the company make the journal entry? The company is basically buying 4,000 shares at $8. So the company will be debiting treasury stock 4,000 multiplied by 8, 32,000, and the company will credit cash 32,000. This is again based on the paid price, not par value. In this case, the amount here will be the contra revenue account will show treasury stock 4,000, and this is the difference between the 100,000 shares that were issued and the 96,000 shares that are outstanding. And this one is deducted from stockholders' equity before getting to the total. So this one minus 32,000 will be equal to the total stockholders' equity. Now, disposal of treasury stock will increase total assets and stockholders' equity. In this case, the company will be selling them for cash, for example, or for other reasons. But when the company sells them for cash, for example, will increase. So the total assets will increase, and at the same time, there will be more stocks outstanding. As a result, the stockholders' equity will increase. And companies, they might sell treasury stock either above cost, this is above the price that was paid to purchase them, or below cost. And the accounting for this the sale of treasury stock will differ whether it was sold above cost or below cost. So this one is above cost. On July 1st, Mead sells for $10 per share 1,000 shares of its treasury stock previously acquired at $8 per share. The company is selling them for $10. So the amount of cash that the company will get will be $10,000. This is based on the selling price. The company will debit cash 10,000. Company will credit treasury stocks 8,000. This is based on the purchase price, based on the paid price. So the price to acquire them, acquire treasury stocks. The difference between the two will be credited to paid-in capital from treasury stock. Now the company will not recognize a gain or a loss from selling or from treasury stock transactions, because this is a transaction between the company and its own shareholders. Plus, a gain or a loss usually is the result of the sale of an asset. Here, treasury stock is not an asset, so it's not. The company will not recognize a gain or a loss, and the companies will record the paid-in capital from treasury stock under the stockholders' equity section of the balance sheet. Now, if the company is selling treasury stocks below cost, here Mead sells an additional 800 shares of treasury stock at $7 per share. So it is the amount of cash that the company will get will be 800 multiplied by 7. So the company will debit cash 800 multiplied by 7, which is 5,600. This is 800 shares multiplied by $7, and that is the selling price. The company will credit. Treasury stock 800 multiplied by 8. The difference between the two will be debited to paid-in capital from treasury stock. So it will be paid-in capital from treasury stock. This is the difference between the two, between selling and purchase prices, and this is based on the paid, basically, or the purchase price. So this is 800 multiplied by $8. So as a summary, treasury stock was purchased originally. If you remember, the company bought 4,000 shares for $8. That was 4,000 shares multiplied by 8. The company later on sold 2,000, and then they sold 1,000, and then 800. So the company sold 1,000 multiplied by 8, and then 800 multiplied by 8. On the other hand, the paid-in capital from treasury stock, we had two transactions. We had a credit to paid-in capital from treasury stock. This was the difference between when it was sold. This was from the previous slide, when the company sold 1,000 shares at $10 minus 1,000 shares multiplied by 8, and then this debit here is from this amount here. The balance will be $1,200. It is important to remember that treasury stock is always recorded at cost, whether it was sold above or below cost. Now, the original paid-in capital account, in this case, which is the common stock, the common stock account will not be affected, because selling treasury stocks will be affecting treasury stock and total assets. So let's assume that on December 1st, assume that Mead Inc. sells its remaining 2,200 shares at $7 per share. So once again, this is below cost, and the company will be debiting cash 2,200 shares multiplied by $7. The company will be crediting. Treasury stock 2,200 multiplied by $8. The difference between the two is 2,200. So this is the difference. This one is the difference. However, because in the balance in the previous slides, as you can remember here from the previous slide, the balance was 1,200 and paid in capital. Because the company only had $1,200 from paid in capital, company will debit paid in capital from treasury stock 1,200 and will debit the remaining 1,000 to retained earnings. This is because we don't have enough in the balance of paid in capital from treasury stock to cover the difference, so the company will take this money basically by debiting retained earnings, that difference between those amounts. So ABC Inc. sells 100 shares of $5 par value treasury stock at $13 per share. If the cost of acquiring the shares was $10 per share, the entry for the sale should include credits to, once again, we need to write the journal entry. The company is selling 100 shares at $5 par value. Company is selling that at $13. So this is the selling price. It's $13. If the cost of acquiring the shares was $10, this is the paid price of treasury stocks. We need to write the journal entry. The amount of cash that the company will get is always the same. Cash will be according to the selling price. It is 100 shares multiplied by $13. So it is $1,300, which is 100 shares multiplied by 13. The company will credit treasury stock the amount that was paid when they acquired it, which was $1,000. Again, this was $100 shares multiplied by $10. And the difference between the two will be credited to paid in capital from treasury stock. It will be credited 300. It will be credited 300, which is the difference between the two. As a result, the answer will be a credit of 1,000 to treasury stocks and 300 to paid in capital from treasury stocks. Andrews Inc. paid $45,000 to buy back 9,000 shares of its $1 par value common stock. The stock was sold later at a selling price of $6 per share. Once again, we need to the entry to record the sale includes, this is the price of acquiring. So this was the paid price. This is the cost of acquiring treasury stock par value. And then we have here, the stock was sold at $6 per share. So the journal entry would be the company will be debiting cash 9,000 multiplied by 6, which is 54,000. This is 9,000 shares multiplied by $6. The company will be crediting treasury stock. The cost, which is 45,000, and the difference between the two is credited to paid in capital from treasury stock. That will be the difference of 9,000. Now, as you can see from this example and from the one before, that par value is not involved in accounting for treasury stocks. It is used for common stocks, but when we account for treasury stocks, the par value is not included in the journal entry. Here, the answer would be B, because we credited paid in capital $9,000. So far, we have been talking about common stock, about just this one type of stock, which was common stock, and treasury stocks are basically common stocks that the company has bought back. But companies might offer a different type of stocks, which is preferred stock. And basically, like the name suggests, there are certain additional features that preferred stocks come with, such as, for example, they have a preference to dividends. They have the right to get paid their dividend before common stocks. They have also the right to claim their claim to the assets comes before, in the case of companies liquidation, is before common stocks. Basically, if the company is bankrupt and is liquidated, first the creditors and lenders will get their money, and then preferred stockholders, and finally common stockholders. Generally speaking, this kind of stocks, while they have preference to dividends and to assets in case of liquidation, they are non-voting stocks. They don't have the right to vote. And here, the way we account for preferred stock is very similar to common stock, but basically we changed the name from common stock to preferred stock. And it is actually listed on the stockholders' equities under the stockholders' equity section of the balance sheet before common stock, due to their preferred, basically due to their privileges. So let's see how we make the journal entries for these. Stein Corporation issues 10,000 shares of $10 par value preferred stock for $12 cash per share. The journal entry to record the issuance will include, once again, the company has issued 10,000 shares of $10 par value for $12. So this is par value. This is the selling price. The company will debit cash. The company will debit cash 120,000. This is according to the selling price. The company will credit preferred stock 100,000. This is based on the par value, and the difference between the two will be credited to paid in capital in excess of par from preferred stocks. And again, this is the difference between the two. Once again, preferred stocks, they may be par stock, they might have par value, or it might be no par value. The main advantage of privilege of preferred stock is dividend preferences. This is basically the fact that the company will first pay preferred stockholders any dividend that they have the right to, in addition to any previous dividends that were not paid from previous years. Now, it is important to understand that that claim to dividends does not mean that the stockholders actually receive the dividend. If they have the right to a dividend, it does not mean that they will actually receive it. In certain cases, the company does not declare a dividend, in which case those dividends that that the preferred stockholders has the right to, but does not actually receive, become what we call dividends in arrears. So those are dividends in arrears. Those are dividends that are that have been that were not paid from previous years. Now, dividends are usually either they are stated either as a dollar amount per share or as a percentage of the par value. Now, cumulative dividend is the right, like we said, is the right of the of the preferred stockholders to get not only not only the current period's dividends, but also any dividends that were from previous accounting period. Basically, this is any dividend in arrears. So let's see how this works. Scientific Leasing has 5,000 shares of 7% $100 par value, cumulative preferred stock outstanding. Each $100 share pays $7 dividend. The annual dividend is $35,000. If dividends are 2 years in arrear, preferred stockholders are entitled to receive the following dividends in the current year. So dividends in arrear are, for every year, preferred stockholders have the right to get $35,000. If they have been 2 years in arrears, so the dividends in arrears will be 2 times 35,000, which is 70,000. So this is basically 2 multiplied by 35,000. The current year's dividends is again 35,000. As a result, the total preferred dividends for that it will be that they are entitled to will be 105,000. In this case, if the company has declared dividends, preferred stockholders will have the right to get 105,000 before anything is paid to common stockholders. And this is what we mentioned when we talked about preferred stocks, having the right to having basically they have a stronger claim against. Basically, they get their money first if, in the case the company default, or the company goes bankrupt, or in the case of the company, if the company is liquidated, they get their money first before common stockholders get anything. This is, of course, after the company has paid creditors and after paying the creditors and lenders their the money that they own, or the money that the company owes them. So Beckham Company has 1,000 shares of 6%, $100 par cumulative preferred stock outstanding at December 31st, 2011. No dividends have been paid on this stock for 2010 or 2011. So the dividends that will be in arrear at the end of the year will be, here it will be 6% multiplied by $100. So it is 6% multiplied by $100 par value multiplied by 1,000 shares, which is $6,000 per year. This is for 2 years. As a result, the answer will be 12,000. Now, dividends is the part of the net income that the company decides to pay back to give back or to distribute to its shareholders, and the distribution of dividends is usually depending or depends on the on each shareholder's ownership of the company. So, for example, if you own 10% of the company, of the outstanding company's stocks, you will have the right to 10% of the distributed dividends. There are different types of dividends. There are cash dividends. This is the most common one. And there is also a fairly common one, which is stock dividends. There are also property dividends as well as scrip or promissory note. Those are less common. In this chapter, we will focus on the first two, which are the most common ones: cash dividends and stock dividends. Now, dividends is usually reported quarterly as a dollar per share, basically as either as a percentage, either as a dollar amount per share or as a percentage of the par or stated value. Now, so for when cash dividend, as far as cash dividend is concerned, there are the company will basically the board of directors will have to evaluate the retained earnings to make sure that to make sure that they have enough money, because as you remember, it is illegal in most states to pay cash dividends from paid-in capital. Instead, the companies, they have to use the retained earnings to pay cash dividends. And then the board of directors will have to look at how much cash the company has, because the dividends is in cash. At that point, they need to see whether their current needs as well as the near future needs of the company, basically the future needs of the company to pay their debts, to expand their business, etc. Whether they need to consider to take that into consideration to see whether they have enough cash to pay cash dividends. And the third step would be if the board of directors decides that they have enough cash and that they can pay, they will declare a dividend, and at which point it becomes an obligation. The company will not have the right to go back on this decision. They don't have the right to basically cancel the declaration of a dividend. Once the company or the board of directors declares dividend, the company will have basically to pay it. There are three important dates that are involved in cash dividends. The first date is when the company's board of directors declares dividend. This is the declaration date. This is when the board of directors authorizes the company to pay to distribute cash dividends to its shareholders. They will decide on the amount and on that day, and it becomes basically an obligation. There is also the record date. This is when the company updates their databases, or their owners' databases, basically, to make sure that they have a list of all the registered shareholders who have the right to receive dividends. Basically, they need to know who to send the dividends to. The third date will be the payment date. This is when the company actually sends out the checks to shareholders. The company on this date, they will send out the checks to the shareholders as of date that was on the record date. So the payment will be for shareholders as of the 22nd, for example, of December in this example. And usually there are like a couple of weeks, 2 to 4 weeks between each date, let's say each date and the following one. So let's see the journal entries, how the company would record the journal, how they would record the payment and declaration of dividends, and how they would record those 3 dates. So on December 1st, the directors of Media General declare a 50-cent per share cash dividends on 100,000 shares of $10 par value common stock. The dividend is payable on January 20th to shareholders of record on December 22nd. On the declaration day, the board basically has committed the company to a legal obligation. Now they owe the shareholders this money, so the company will debit cash dividends. So the company here will debit cash dividends, 50,000. This is 100,000 shares multiplied by 50 cents. But because the company will not pay it immediately, it automatically becomes dividends payable, which is a current liability. On the second date, which is the date of record, this is December 22nd, the company is simply updating their records. As a result, the company will not make a journal entry. The company's financial position did not change. There was no exchange of assets, etc. There was no dividend that was actually paid. The company is simply preparing a list of the eligible stockholders. On January 20th, this is the payment date. This is when the company is actually sending out the checks. The company will be, at this point, the company will be debiting dividends payable because they are paying their liability in cash. Because it is a cash dividend, the company will credit cash 50,000, and of course the company will debit dividends payable 50,000, will credit cash 50,000. At this point, both current assets and current liabilities have decreased because the company is paying their debt using an asset which is cash. So the current assets will decrease, current liabilities will decrease, but in this case, stockholders' equity will not be affected. Stockholders' equity was affected in the first date, when on the declaration date when cash dividends was declared. Now let's see how cash dividend will be allocated between the preferred stocks and common stockholders. Remember that preferred stocks have the right to a cumulative basically dividend. So the cumulative preferred stock, they will have the right to get paid current dividends as well as dividends in arrears. So let's see how this will be recorded. On December 31st, 2014, IBR Inc. has 1,000 shares of 8% $100 par value cumulative preferred stock. It also has 50,000 shares of $10 par value common stock outstanding. At December 31st, 2014, the directors declare a $6,000 cash dividend. We need to prepare the entry, the journal entry to record the declaration of the dividend. Whenever we make the journal entry to declare for the declaration of dividends, the company will simply debit cash dividends 6,000. This is the dividend that was declared, and they will credit dividends payable 6,000 because they haven't paid it yet, so it becomes an obligation. Now, the amount of dividend that the preferred stockholders will have the right to every year is 8,000. Every year they will have the right to 1,000 shares multiplied by $100 multiplied by 8%. And so in this first year, all the declared dividends will go to preferred stockholders, and common stockholders will not get anything. In fact, preferred stockholders will still have $2,000 dividends in arrears. So on December 31st, 2015, this is the second year, IBR declares a 50,000 cash dividend. The allocation of dividends to each class of stock will be as follows. For 2014, the dividend that was declared was 60,000. It all went to preferred stockholders. In 2015, the dividends that were declared are 50,000. The dividends in arrear, as you remember, were 2,000. Those are basically the 8,000 from 2014 that they were entitled to in 2014 minus the 6,000 that were actually paid in 2014. And in addition to 8,000 from this year, this is from 2015. So as a result, the preferred stockholders will get So preferred stockholders will actually get $10,000, and the difference between $10,000 and the dividends that were declared, basically the remaining ones will go to common stock. So this one is actually 50,000 that were declared minus the 10,000 that will be given to preferred stockholders. The journal entry to record this declaration will again be the same. The company will debit cash dividends 50,000 and milk credit dividends payable 50,000. It does not change. Only the journal entry will be the same. What will change is the allocation of payments to each type of stock. The other type of dividends that we will discuss in this chapter is stock dividends. This is when the company, instead of distributing dividends in cash, they will issue and distribute their own stocks. This will increase the number of shares outstanding. However, the percentage of ownership in the company will not be affected. So basically, if you originally had 25%, they say that this was 25% of the shares. After issuing the dividends, it will still be 25% of the shares. However, originally you had 40 shares. Now, in this case here, you have 120 shares. So the number of shares will change, but the percentage of ownership will remain the same. It will not be affected. And generally speaking, this will decrease retained earnings and it will increase paid-in capital. What we're doing here is basically we are permanently reinvesting part of the retained earnings in the form of common stock. This is in the form of company stocks and paid-in capital. So here, when the stock dividend is issued, the board and the company will take into consideration the market value of the dividends. They need to know basically what the value of those stocks are, and the companies would, there are several reasons why companies would declare and distribute stock dividends. For example, if they want to please their investors and they don't have enough cash to pay cash dividends, they might distribute stock dividends. They might want to increase the marketability of the company's stock by increasing the number of shares that are in the stock market. And another reason might be that the company might want to basically emphasize that a part of the retained earnings has been permanently reinvested in the company. What that means is that because it will become a paid-in capital, and at that point, that would be permanently invested in the company. There are two types of stock dividends. It could be a small stock dividends with less than 20 to 25% of the total issued stocks, or a large stock dividends which is greater than 20 to 25%, which is less common in general, and usually large stock dividends are recorded at par value compared to the small stock dividends which are recorded at market value. And here the reason why they will be recorded at fair value is that the reason why the company would record them at fair value when they issue small stock dividends is that the amount of stock dividend is immaterial, and as a result, it will not really affect the market price of the other shares. So if it is, for example, 10%, it is not very likely to affect the price of the existing stocks of that company. So Medland Corporation has a balance of $300,000 in retained earnings. It declares a 10% stock dividend on its 50,000 shares of $10 par value common stock. The current fair market value of its stock is $15 per share. Now, when the company issues stock dividends, we need to see whether this is a small stock dividend or a large stock dividend. So if it's a small stock dividend, the company will be using the fair market value to record the transaction. So basically here we'll use $15. This is $10 par value. So the company will be debiting stock dividends 50,000 multiplied by 10% multiplied by $15. That would be 75,000. So basically this is the 10% of the stock dividend, which is 5,000 shares. This is 10% of 50,000 shares, so it's 5,000 shares multiplied by $15. This is per fair market value. So this is market according to the market value. Now, the common stock dividends distributable will be like common stocks at par value. So in this case, it is 5,000 shares multiplied by $10 par value, and the difference between the two will be credited to paid-in capital in excess of par value. Now, common stock dividends distributable is not a liability. It is a stockholders' equity account. Liabilities are expected to be paid back using an asset, whereas common stock dividends distributable will not be paid back by an asset. It will simply be distributed it will simply be later on when the stock is issued. The company will be debiting common stock dividends distributable 50,000 and crediting common stock 50,000. Once again, this is based on par value. So it is important to remember that common stock dividends distributable is not a liability. It is a stockholders' equity account, and actually it will be reported under paid-in capital. So it will be actually added to common stocks. So on the stockholders' equity, under the stockholders' equity section on the balance sheet, the company will report common stock, and then common stock dividends distributable will be added to that amount. So the effect of stock dividends on the company's numbers will, as you can see here, before the company has issued dividends, the company had the common stock was 500,000 and it had 30,000 in retained earnings. The total stockholders' equity is 800,000. After the dividend was issued, the common stock has increased, paid-in capital has increased, and retained earnings has decreased. The total stockholders' equity remains unchanged. So the number of outstanding shares has increased. This one has increased. Paid-in capital has increased, but retained earnings has decreased. So what happens here is that there was a transfer from retained earnings to paid-in capital. There was a transfer of 75,000. The total stockholders' equity is not changed, but the number of shares has increased. It was 50,000, now it's 55,000, but the par value of each share remains unchanged. So here in this case, we did not change the price, par value. We simply increased the number. The company has simply increased the number of outstanding shares. Total stockholders' equity will not be affected because it was basically a transfer from retained earnings into paid-in capital. And like we mentioned before, this is what we mean by permanently reinvested, because the company has taken that from retained earnings and they have put it in paid in capital section. On January 2nd, 2008, Riley Corporation issued 20,000 shares of 6% cumulative preferred stock at $100 par value. On December 31st, 2011, Riley Corporation declared and paid its first dividend. What dividends are the preferred stockholders entitled to receive in the current year before any distribution is made to common stockholders? So whenever we have a question like that, again, we need to look at the number. We need to look at the dividends in arrears. So here in 2008, preferred stockholders had the right to 6% multiplied by $100 par value multiplied by 20,000 shares. So that was actually $120,000 per year. So those are per year. So in 2008, it was 120,000. In 2009, 2010, and finally in 2011, the company this is when the company actually paid its first dividends. The amount that preferred stockholders are entitled to receive at this point will be 120,000 multiplied by 4 years, which will be equal to 480,000. Here, dividends in arrears will be 3 years in addition to the current year. So at this point, it is 480,000. Rancho Corporation sold 200 shares of treasury stock for $40 per share. The cost for the shares was $30. The entry to record the sale will include, once again, we need to make the journal entry here. The company sold treasury stocks for $40. This is a revision of the previous part when we were talking about treasury stocks, sales of treasury stocks. So the company sold treasury stocks for $40 per share. So the company will debit cash 40 multiplied by 200, that would be $8,000. This is according to the selling price. That's 40 multiplied by 200 shares. The company will credit treasury stocks 200 multiplied by 30, which is $6,000. This is according to the cost. And the difference between the two will be paid in capital in excess, paid in capital from treasury stocks. That will be the difference of 2,000. So in this case, the correct answer will be A, because it includes a credit to paid in capital from treasury stock for 2,000. So far we have been talking, we talked before about issuing stock dividends. Stock split is different. It is not paying a stock dividend. It is, however, similar to stock dividends in that it will increase the number of stocks. It will double basically it will increase the number of stocks to the shareholders. And however, it also includes a decrease in par value that is proportional or inversely proportional to the number of basically the ratio of splitting the stock. So if you split the stock with a ratio of 2 to 1, you will be doubling the number of stocks. At the same time, you will be decreasing or dividing the par value by half. So The result of a stock split will be a decrease in par value and an increase in the number of shares. The total value will be the same. This is usually important because companies sometimes they split their stock when the stock price gets too high, and in order to improve its marketability, they split the stock. At that point, it would decrease. The market value of the stock will decrease, and it will be more affordable, basically, or affordable to more people who might be interested in buying that stock. Nike, for example, they split their stock, which used to be at $111, and as soon as they split the stock, the stock value went down to $55. But then it very quickly increased again, and it went up to $100, although they had increased the number of shares. So the effect of the split on the market price is generally inversely proportional to the size of the split. Now, when the company split their stock, they don't need to make any journal entry because there is no change to the total stock. Basically, there is no change to the total stockholders' equity. The total paid-in capital, retained earnings, and stockholders' equity, they are not affected. What will be affected is simply the number of outstanding shares and the par value per share. As you can see, this is 50,000 multiplied by 10. This is 500,000, and this one is 10,000 multiplied by 5 is 100,000 multiplied by 5, which is also 500,000. The difference here is 0. There is no difference. There is no change when the stock is split. This is different from from when the company declared and distributed stock dividends. In this case, what will change is simply the number of outstanding shares and the par value per share, but paid-in capital, total stockholders' equity, retained earnings, those will remain unaffected. And this is why the company does not recognize this event. Now we'll get to the other source of stockholders' equity, which is retained earnings. We talked about paid-in capital, talked about common stock, preferred stock, treasury stock, etc. Here now we talked about paid-in capital in excess of par value and stated value. We talked about dividends. Now we will talk about retained earnings. So this is the other source of stockholders' equity. We talked before about paid-in capital. Now we will talk about retained earnings. Now, so this is the part of net income that the company keeps in the business. And when the company has a net income, it will increase retained earnings. When the company has a net loss, it will decrease retained earnings. And this is basically here, this is part of the stockholders' claim against the total assets. It's not against a specific asset, it's against the total assets. And most of the time, retained earnings would have a credit balance, but in certain cases, if it does have a debit balance, that would mean that the company, this is usually called a deficit. It means that the company is, basically that the company has a deficit here. There are sometimes certain restrictions on retained earnings. They make part of the retained earnings basically unavailable for distribution as dividends, and there might be several reasons for that. For example, it could be legal restrictions. For example, the price, like restricting retained earnings for the stock, for the treasury stock, or it could be contractual restrictions. For example, the bank would require the company to leave part of the retained earnings restricted so that it would not be distributed as dividends. And in certain cases, it is also voluntary restrictions where the board of directors would restrict part of the retained earnings for future expansions. Because generally speaking, and theoretically speaking, if the retained earnings were not restricted, the company can basically distribute as dividend the whole balance of retained earnings. But this is not done in reality because the companies always keep part of retained earnings for future expansions, as well as for companies for the company to be able to meet their obligations. And usually the companies, they have the right, they have to disclose any restrictions on retained earnings in the notes to the balance to the financial statements. So here, for example, this notes here, it shows the restrictions. This notes here shows the restrictions on the retained earnings. Here the company says, for example, that certain of the company's debt agreements require compliance with debt covenants. Management believes that the company is in compliance with such requirements, so the unrestricted retained earnings of 223.8 million after meeting those requirements. So the company here has unrestricted retained earnings of 223.8 million because mostly of debt agreements. So they have the long-term debts. Probably they have some contracts where they required that part of the retained earnings must be restricted. Now, in certain cases, there might be an error. The company might discover an error in the financial statements. If the company discovers an error in the financial statements, they have to correct this error. When the company discovers that there was an issue with, there was an error in net income, they will correct it. They cannot, because at the end of the accounting period, the company closes net income, basically income summary to retained earnings. The company will be, that means that the error in net income has directly affected current retained earnings. As a result, the correction will be made to the balance and retained earnings. There are several possible reasons for such an error. It could be a mathematical mistake. It could be an intentional mistake. It could be using the wrong accounting principle, etc. And the adjustments, they have to be made to the beginning balance of retained earnings. So, like we said, the correction will be to the beginning balance of retained earnings because we cannot make the correction to the income statement. Basically, we cannot make the correction to the current net income because net income is for that suffered from an error was from a previous accounting period and not from the current one. As a result, it is not correct to make the adjustment or the correction to the current net income because it's not affected by this error. What is affected is actually the current balance of retained earnings. Assume that General Microwave discovers in 2014 that it understated depreciation expense on equipment in 2013 by $300,000 due to computational errors. These errors overstated both net income for 2013 and the current balance in retained earnings. The entry for the prior period adjustment, ignoring all tax effects, is here. The company will be making the adjustments to the current balance and retained earnings because net income was close to retained earnings. As a result, we cannot make the adjustments to that account to income summary from 2013. In this case, income summary accounts, they for the previous year, were close to retained earnings, and as a result, we cannot make the adjustments to the income summary, the income statement account from this current year. So the company because retained earnings, the beginning balance of retained earnings was overstated, we need to decrease it. As a result, the company will debit retained earnings 300,000. This is the error, and will credit accumulated depreciation 300,000. And then later on, the company will be reporting this as on the retained earnings statement. It will show the balance, the beginning balance as reported. So this is the amount as reported. And then it will also increase the amount. It will also show the correction. And then it will show the balance as adjusted. So the the statement of retained earnings will be such that balance on January 1st, this is the uncorrected one. So for example, here assume that this is the uncorrected one. It is 1,050,000. Net income was 360. Dividends it was 300,000. So basically, this is beginning balance, add net income less dividends, and that would give you the balance at the end of 2014. So this is at the end of 2014. Now, before issuing the report for the year ended December 31st, 2014, you discover a $50,000 error net of tax that caused the 2013 inventory to be overstated. When inventory is overstated, it causes cost of goods sold to be understated, and as a result, net income was overstated in 2013. And because net income in 2013 was close to retained earnings, so the beginning balance here was basically the beginning balance here was overstated. As a result, so will this discovery have an impact on the reporting of the statement of retained earnings for 2014? Yes, this is the account that this is the beginning balance will have to be adjusted to because this is where the net income from 2013 was this is where the income from 2013 will have its effect. So in this case, first, this is the adjusted statement. It will include the balance January 1st as previously reported, and then it will include the adjustment, which is because retained earnings was overstated by 50,000, we will have to decrease it by 50,000, so the error correction, and then we have balance as restated. So you have balance as previously reported and balance as restated. Now this is the new beginning balance. Then we add net income from 2014. We deduct basically less dividends from 2014. That will give us the balance at the end of 2014. So here, basically retained earnings. When we have a net loss, it will be debited. When we have an adjustment for an overstatement in an adjustment for overstatement of net income from previous years, this is when there is an error and we are correcting it, we will debit retained earnings. Cash dividends and stock dividends, basically dividends will be debited to retained earnings. This is when dividends are close to retained earnings. And we have also, as you remember, we have basically the beginning balance, add net income or subtract net loss, and then we also have less dividends. And some disposal of treasury stocks, if you remember, this is when we don't have enough balance in paid-in capital from treasury stock. This is the one where, like in this slide here where we don't have enough balance in the paid-in capital from treasury stock, so we debited retained earnings. On the other hand, retained earnings will be credited when the company has a net income and when the net income of the previous year was understated. So this is how the corrected retained earnings statement will look like. We have the balance as reported. Then we have the correction. So we have later on the balance as adjusted. We add net income less dividends, and that would give us the ending balance of retained, basically the ending balance of retained earnings. Now, investors and creditors, etc., they are interested in knowing, especially investors, they are interested in knowing the profitability of their investment in the company. So return on common stockholders' equity, this is basically the net income that is available for common stockholders divided by the average common stockholders' equity. This is where we exclude preferred stocks because this is common stockholders. So as a result, we exclude the net income available for preferred stockholders, and we exclude the average preferred stockholders' equity. And here the ratio, it shows basically how many dollars of net income will the company make out of make out of each dollar invested in that invested by common stockholders. So it is how many dollars of net income that will be earned from each dollar of investment in common stocks. So to illustrate, let's look at, so for example, Walt Disney Company's beginning of the year and end of the year common stockholders equity were $31,820 and $30,753 million respectively. Its net income was $4,687 million, and no preferred stock was outstanding. So there is no preferred stock. All this equity is for common stockholders. The return on common stockholders' equity will be computed by dividing net income available to stockholders' equity. So net income was $4,687 minus, this is for preferred stockholders, it's 0. So we divide the net income by the average common stockholders equity, which is the beginning balance and ending balance over 2. That would tell us that return on common stockholders equity is 15%. Basically, every dollar invested in Walt Disney, every dollar invested in common stocks in Walt Disney will earn $0.15 for stockholders. And this is how the stockholders' equity section of the balance sheet would look like. We have the two main sections, paid-in capital and retained earnings. And we also have less treasury stocks, which is the contra stockholders' equity account, which will be deducted from stockholders' equity. We have capital stock, so we have preferred stocks, we have common stock, we have common stock dividends distributable. That would give us the total capital stock. So in addition to that, we have also additional paid-in capital. This is in excess of par value, in excess of stated value, etc. So the total paid-in capital is this amount here. Retained earnings would also, as you can see here, we have C note R. So in the notes, it would say that retained earnings is restricted for the cost of treasury stock for 80,000. So here, the company's retained earnings will have also a part that is restricted for the value of 80,000. And this total amount here will be the total stockholders' equity, which would be paid in capital plus retained earnings minus treasury stock. Now, another value that investors are interested in is to know basically to know the equity that a common stockholder would have in the company's net assets. Remember that net assets is equal to total assets minus total liabilities, which means also the stockholders' equity. This is basically to say what part of stockholders' equity common shareholders have, and this is per share. So the book value per share is equal to the total stockholders' equity divided by the number of common stocks that are outstanding. If the company only has one class of, this is when the company has only one type of stocks, which is common stocks. If the company has more than one kind of stocks, first we need to calculate the preferred stock equity, and then we need to subtract that from total stockholders equity to basically determine the common stockholders equity. After that, we divide this amount by the outstanding number of common shares, and that would give us the book value per share. So, for example, Grabber's preferred stock is callable at $120 per share and is cumulative. Assume that dividends on Grabber's preferred stock were in arrears for 1 year, 54,000, which is 6,000 multiplied by $9. The computation of preferred stock equity will be, this is the first step in the previous list. The call price is 6,000 shares multiplied by $120. It is callable at $120 per share. So this is 720,000, and the dividends that are in arrear will be 54,000. So this is the amount, this is the preferred stocks equity in the company. This is the preferred stocks part of the stockholders' equity. And this was taken from these numbers here. So the preferred stock equity was 774,000. The total stockholders' equity was 4,810,000. This is again from this number here. As a result, total the common stock equity will be equal to total stockholders' equity minus preferred stockholders' equity. That would give us the common stock equity. We divide this one by the outstanding common stocks. So we divide this one by the number of shares number of common stocks that are outstanding, and that would give us the book value per share. Now, it is important to understand that the book value is different from the market value. The market value is driven by the demand and supply. It is affected by companies' earnings, by companies' dividends, by other factors that might not even affect, that might be out of the company's control. On the other hand, the book value is simply based on the cost records. Those are based on the company's records. Market value will depend on the investors and the demand and supply, and the relation between the two is not, in many cases, it's not at all related. And if the market value is greater than the book value, this does not mean that it is overpriced. It is not related. One of them is the value per books. The other one is the value according to the market, and which is driven by supply and demand and by the recession, by economic situation, by similar companies in the same industry, etc. So the book value is important mostly in certain court cases where the rights of individual parties are based on cost. It can also be useful to determine the trend of stockholders' equity per share. This is the importance of the book value per share. So common stock, $5 par value, 1,100,000 shares were issued, and 1 million shares are outstanding. So this is the stockholders' equity section on the balance sheet. Additional paid-in capital is 1,400,000. Retained earnings is 1,500,000. Treasury stocks, 100,000 shares. This is the difference between issued and outstanding shares. And treasury stocks are 700,000. So the total stockholders' equity is 7,700,000. What is the book value per share for common stock? In this case, we don't have a preferred stock, so we don't need to basically subtract the preferred stock equity from the total stockholders' equity. Here we can use stockholders' equity, total stockholders' equity, and divided by the total number of outstanding shares. So basically it is 7,700,000 divided by the number of shares that are outstanding, which is 1 million, and that would give us $7.70. That would be the book value per share of common stock, is $7.70. With that, we conclude the chapter on where we covered various accounts related to stockholders' equity.